Euro struggles despite US dollar pullback. The euro is facing mixed signals despite a recent pullback in the US dollar, USD. Here's a breakdown of the key factors. Euro's woes. Weak Eurozone PMI data points to a contraction in the manufacturing sector and a slowdown in services. Rising concerns about a potential global trade war could further dampen Eurozone economic activity. The ECB is expected to cut interest rates, further weakening the euro. Euro's glimmers of hope. A recent rebound in euro to US dollar suggests a potential short-term correction. The appointment of Scott Bessent as U.S. Treasury Secretary may lead to less aggressive trade policies, benefiting the euro. U.S. dollar's strength. Strong U.S. PMI data indicates robust economic growth, supporting the USD. Expectations of a slowdown in Fed rate cuts could boost the USD. Overall outlook. The near-term outlook for euro to US dollar is uncertain. A break below 1.0333 could signal further euro weakness. Market focus this week is on Eurozone CPI data and US PCE data, which will influence interest rate expectations. Headline ideas. Euro stumbles despite dollar retreat as recession fears linger. Euro seeks solace as US dollar pulls back, but challenges remain. Trade war jitters keep euro under pressure despite Bessent boost. Euro to US dollar daily chart. Support 1.0330, S1, 1.0160, S2, 1.0005, S3. Resistance 1.0500, R1, 1.0680, R2, 1.0875, R3. Euro to US dollar appears to be moving in a downwards trajectory, with the pair currently taking aim for our 1.0330, S1, support level. Following the euro's downwards trajectory last week, we would not be surprised to see the bears take a breather, yet we opt to maintain an overall bearish outlook, and supporting our case is the RSI indicator below our chart, which currently registers a figure near 30, implying a strong bearish market sentiment. For our bearish outlook to continue, we would require a clear break below the 1.0330, S1, support level, with the next possible target for the bears being the 1.0160, S2, support line. On the flip side, for a bullish outlook, we would require a clear break above the 1.0500, R1, resistance line, if not also the 1.0680, R2, resistance level, with the next possible target for the bulls being the 1.0875, R3, resistance line. Lastly, for a sideways bias, we would require the pair to remain confined between the 1.0330, S1, support line, and the 1.0500, R1, resistance level. US dollar to Japanese yen outlook, a complex picture. The US dollar to Japanese yen pair is currently facing a complex outlook, influenced by several factors. Diverging monetary policies, the Bank of Japan's BOJ, potential for further policy normalization contrasts with expectations of a potential Fed rate cut. This divergence could lead to a narrowing of the US-Japan yield spread, putting downward pressure on the US dollar to Japanese yen. Geopolitical tensions. Escalating geopolitical tensions could boost safe haven demand for the Japanese yen, further weakening the US dollar to Japanese yen. Technical analysis. Technical indicators suggest a potential downside bias, with support levels at 153.30 and 152. However, a break above 156.25 could signal a continuation of the uptrend. Overall, while a downward trend is anticipated for the US dollar to Japanese yen pair, the path may be volatile due to various factors. Traders should closely monitor developments in both the US and Japanese economies, as well as geopolitical events. US dollar to Japanese yen daily chart. Support 153.30, S1, 150.20, S2, 146.80, S3. Resistance, 156.25, R1, 158.75, R2, 161.65, R3. The pair appears to be moving in a sideways fashion. We opt for a sideways bias for the pair, and supporting our case is the RSI indicator below our chart, which currently registers a figure near 50, implying a neutral market sentiment. Yet should the pair fail to break below our upwards moving trend line which was incepted on the 9th of October, one could argue that the bulls may be simply taking a breather. Nonetheless, for our sideways bias to continue, we would require the pair to remain confined between the 153.30 S1 support line and the 156.25 R1 resistance level. On the flip side, for a bullish outlook, we would require a clear break above the 156.25 R1 resistance line, with the next possible target for the bulls being the 158.75 R2 resistance level. Lastly, for a bearish outlook, we would require a clear break below the 153.30 S1 support line, with the next possible target for the bears being the 150.20 S2 support level. The pound sterling to US dollar currency pair has rebounded from its recent lows, driven by a weaker US dollar and improving sentiment surrounding the British pound. The USD index has pulled back from its two-year high as investors take profits on US Treasury bonds and global equity markets rally. Additionally, the UK's inflation rate has exceeded expectations, reducing the likelihood of a near-term interest rate cut by the Bank of England. While the pound sterling to US dollar pair has shown strength, analysts caution that the overall trend remains bearish, with potential for further downside if the 1.2530 support level is broken. Pound sterling to US dollar daily chart. Support, 1.2485 S1, 1.2350 S2, 1.2215 S3. Resistance, 1.2680 R1, 1.2830 R2, 1.2980 R3. Pound sterling to US dollar appears to be moving in a downwards fashion, despite having bounced off our 1.2485 S1 support level. We opt for a bearish outlook for the pair, and supporting our case is the RSI indicator below our chart, which currently registers a figure near 30, implying a strong bearish market sentiment. Yet, the story is similar to that of the euro, and thus we would be surprised to see the bears take a breather, with the bulls potentially aiming to test the 1.2680 R1 resistance line before ceding control to the bears once again. Nonetheless, for our bearish outlook to continue, we would require a clear break below the 1.2485 S1 support level, with the next possible target for the bears being the 1.2350 S2 support line. On the flip side, for a bullish outlook, we would require a clear break above the 1.2680 R1 resistance line, with the next possible target for the bulls being the 1.2830 R2 resistance level. Lastly, for a sideways bias, we would require the commodity to remain confined between the 1.2485 S1 support level and the 1.2680 R1 resistance line. Global oil prices, particularly WTI, have seen a recent uptick due to escalating geopolitical tensions between Russia and Ukraine. This has sparked concerns over potential supply disruptions, as both countries are major oil producers. Additionally, Iran's nuclear program and its confrontations with the UN nuclear watchdog have further added to market volatility. Despite some upward pressure, rising U.S. crude inventories and a stronger U.S. dollar could limit further gains. However, the overall trend suggests that oil prices may remain elevated in the near term, driven by geopolitical risks and potential supply shortages. WTI cash daily chart. Support, 64.75 S1, 57.30 S2, 49.30 S3. Resistance, 71.85 R1, 78.00 R2, 83.45 R3. On the commodities front, oil prices appear to be moving in a sideways fashion after failing once again to break above the 71.85 R1 resistance line. We opt for a sideways bias for the commodities price, and supporting our case is the narrowing of the Bollinger Bands, which tend to imply low market volatility in addition to the failure to break above our aforementioned resistance level. Moreover, the RSI indicator below our chart currently registering a figure of 50, which tends to imply a neutral market sentiment. For our sideways bias to continue, we would require the commodity to remain confined between the sideways moving channel defined by the 64.75 S1 support level and the 71.85 R1 resistance line. On the flip side, for a bearish outlook, we would require a clear break below the 64.75 S1 support level, with the next possible target for the bears being 57.30 S2 support base. Lastly, for a bullish outlook to occur, we would require a clear break above the 71.85 R1 resistance line, with the next possible target for the bulls being the 78.00 R2 resistance level. US 500 daily chart. Support: 5885 S1, 5675 S2, 5400 S3. Resistance: 6030 R1, 6250 R2, 6525 R3. The S&P 500 appears to be on track to form another new all-time high, after failing to break below our 5885 S1 support level. We opt for a bullish outlook for the index, and supporting our case is the RSI indicator below our chart, which currently registers a figure above 60, implying a bullish market sentiment, in addition to the upwards moving trend line which was incepted on the 4th of November. For our bullish outlook to continue, we would require a break above the 6030 R1 potential resistance level, with the next possible target for the bulls being the 6250 R2 resistance line. On the flip side, for a sideways bias, we would require the index to remain between the 5885 S1 support level and the 6030 R1 resistance level. Lastly, for a bearish outlook, we would require a clear break below the 5885 S1 support level, with the next possible target for the bears being the 5675 S2 support line.